So taxes can be one of the largest expenses that retirees have during their retirement. And so having a plan for it is really critical. Sometimes retirees don't realize that once they are in retirement, that they are also responsible for not only how much taxes they pay, but how they go about and paying those taxes. So it's critical to know that by creating a retirement income plan, if without doing that or projecting what your future income will be, how can someone make good decisions regarding their taxes? And once you know what your income will look like, then you can make better decisions on which account do I draw from. Every account has different tax consequences. Your pension, Social Security are taxed differently. So understanding all these different rules and which accounts to draw from can allow you to create a tax efficient stream of income to last throughout retirement. So the place that I like to start with first is the 3 types of investment accounts. Each has its own tax rules. The first bucket is tax deferred accounts like your IRA and 401k accounts, which they're considered pre-tax accounts because money that you put into those was not taxed, but will be taxed in retirement once you withdraw money from those accounts. With those accounts, you won't be able to keep that money in there for forever. There will be required minimum distributions that will force you to take out a certain amount of money later in retirement, which can create a big tax nightmare. The second tax bucket is tax-free or Roth investment accounts. So this might be a Roth IRA, a Roth 401k, 403b, and so forth. Essentially, money that goes into these accounts are after tax, meaning you've already paid taxes on those dollars, but will allow that money to grow tax-free and be able to use in the future tax-free when you withdraw from it later in retirement. And then the last tax bucket is what I call taxable brokerage accounts, which just simply means that the reason why they're called taxable is because as you make money within those accounts over time, you're paying taxes along the way on your investment earnings. So things like interest, dividends, or if you buy an investment and sell it for a profit, then you have to report those capital gains on your tax return. And so you pay taxes as you go. But that account can also be really important, especially for early retirees. Living on that money for the first part of your retirement can make a big difference on how much you pay for health insurance in your retirement. So understanding all 3 of those different buckets is key to creating a tax efficient stream of income to last throughout retirement.